I would agree. No one thinks this will be easy. No one thinks it's straightforward. But there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances; it is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Hi. Thanks, Steve Dorsey, CBS. You mentioned earlier, just now, fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there. And we look at it as our job to, given all the factors that are happening, to try to sustain maximum employment and price stability. So if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Okay, Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. So we're absolutely prepared to do that. It wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. But I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Okay, Chris Rugaber.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Thanks. Mike McKee.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure a certain quantum of balance sheet shrinkage compared to quantitative easing. And these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that. So, in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and so that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got 3 or 4 really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing, and it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices, and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion, too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Short and sweet from Chairman Jay Powell there, wrapping up that meeting from New York City for our audience worldwide on TV and radio. Let's check out the price action for you. Equities up by 2.4% on the S&P 500. On the Nasdaq, up by 2.6%. A big move in the equity market, stocks higher. Big move in the bond market, yields lower, particularly at the front end. Look at this move, down 12, let's call it 13 basis points on a 2-year to 265.63. So what have we got? Equities up, we've got yields lower, we've got a dollar that's weaker. And Lisa, it seems to me that just batting away the question about 75 basis points was sufficient to generate a monster rally in this market.
What does that tell you? I mean, honestly, the idea that this was an outlier case, that people thought that a 75 basis point rate hike was on the table for June, just simply taking that off the table led to a rally that's one of the biggest that we've seen in weeks. How does this really cohere with this idea that they have, I'm sorry, but credibility, if they're basically turbocharging a market and leading people to basically reduce their near-term rate hiking bets at a time when inflation shows no sign of slowing down?
Alongside Tom Keene and Lisa Brabbits, I'm Jonathan Ferro. Let's listen to the chairman himself and what he had to say about 75 basis points.
75 basis point in an increase is not something the committee is actively considering. Assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings.
The chairman of the Federal Reserve, TK, that just goes to show how much was priced in this market, Tom, and how difficult it is to out-hawk this market with expectations so elevated going into this meeting.
He mentioned the 75 basis points, and I would suggest, John, after that, off the question from Colby Smith of the Financial Times, he gave some immense nuance of neutrality. And the red sticky that Bloomberg produced at 1448 says it all, won't hesitate to go higher than neutral if needed. And there seemed to be almost a massive instantaneous sigh of relief over the bandedness, the malleability of the study of neutrality. And I really think that was something exceptionally important in this huge market move.
There is a ton of debate as to whether they will go beyond neutral and how much higher they will ultimately go, and the end destination as well. I want to go through some dates with you all now, just to work out where we're going here. So we've got June and July. June 15th, July 27th. They're the next couple of meetings that the chairman is referring to, and basically putting a 50 basis point rate hike on the table. We have CPI prints on May 11th, June 10th, July 13th, August 10th. And after July, you've got a meeting from the Federal Reserve on September 21st. This, Tom, for me, for many people, for the moment at least, puts the summer to bed. Takes you to Jackson Hole, you reset TK, you look at the data that's come in, and then we can have a bigger conversation about the future. Because as you point out, the move to neutral, expeditiously, a word they like to use, is largely baked in now. The what next after that is going to be dependent on what this data looks like through the summer.
The calculation of neutral is a huge debate. I looked at one paper from the late Robert Kaplan of the Dallas Fed, and John, they have 3 measurements of neutral within that paper. And I'm not willing to say if neutral's July, if neutral's September, if neutral's beyond that. But what I heard was a chairman who made clear they are going to be very supple as they move forward on the data, trying to figure out where that neutrality is.
What we witnessed just then, Lisa, over the last hour or so, I think was the chairman tapping the brakes on a runaway hawkish train.
Yeah.
What you get in after that, as a consequence, is an equity market that's higher and arguably financial conditions that are looser. It's going to be interesting to see how this evolves through the next few weeks and months, because I think we should remind our audience of what happened at the last Fed meeting when the Nasdaq absolutely ripped by more than 3.5%, and then the following month was absolutely dreadful. So Fed day price action doesn't tell you everything. Let's just caveat that there. But financial conditions tighten for a reason, and that was the objective, Lisa. This, I don't know what this is.
Well, you raised a good question. Is he going to be happy with this price action, since it's basically the equivalent of a 25 basis point rate hike if you take a rate cut, I should say, based on the easing in financial conditions, that basically this is the wrong transmission mechanism. Whether it will stick is another story. The other interesting thing is this comes even though this Fed chair seemed a lot less confident about a soft landing. He called it a softish landing, and that it was going to be challenging to get there. I mean, he seemed to be conceding that this is going to be a struggle.
Should we get to a man who disagrees with this whole decision, Tom?
I think
we do that now.
The gentleman from Dartmouth, David Blanchflower, joins us. Of course, his wage curve is iconic in the study of the American and indeed the British labor economy as well. Professor Blanchflower, thank you so much for joining this morning. One of the great concerns here that we're hearing in every surveillance interview is a labor economy on fire. Chairman Powell mentioned that 3-4 times. How fully employed is the backdrop as he searches for a neutral rate?
I thought all that was quite astonishing. I'm sitting looking at a labor market where the employment to population rate is 5 percentage points below where it was in 2000. It's a percentage point below where it was in 2020. And what we know about hot labor markets is that actually the unemployment rate is not the right indicator. What you need to look at is what happens outside the labor force. And basically, if the labor market was hot and firms wanted to get workers, they can find them. They've left the labor force. They left the labor force 18 months ago. So I didn't buy really any of that. I thought this whole thing about the labor market being hot didn't make any sense at all. We're 7 or 8 million jobs below to the equivalent of where we were in 2000. I thought, can I just say, Tom, I thought there was a couple of things. I thought the questioning and the things that have been going on at the Fed were just, it's like everyone's singing from the same hymn sheet. It's as if we're in 1974. What was most telling to me was he said, our tools don't work on the supply side. My view is actually this is a very uncertain time. There really is a debate about, in a sense, the arguments that I'm making, whether they're appropriate or not. I mean, I take the view it's probably less certain than it was in the past. But the Fed had better hope that the consumer confidence data is wrong. And he's exposed himself, I think, to an issue where really bad data comes. And the right question that the audience should have asked him was not, are you going to make a 75 basis point hike? They should have asked him, what would it take you to not make a hike? What evidence are you looking for to not do that? And I just want to be mindful, Tom, that if you look back at what Christine Lagarde said a week ago, she said 2 things. She said, here's the reason we're not raising rates. We're not raising rates, and the Bank of Japan has done the same thing in much the same circumstance. And she said 2 things: the war in Ukraine and consumer confidence that's collapsed. So the ECB has much the same data as the US. Consumer confidence data has collapsed. Consumer weak, GDP weak. So there really is a split in view. And I was very struck by what the Fed has now done is it's exposed itself. It's exposed itself to bad data. So you could say, oh, well, a month or two. If the likelihood is that consumer spending collapses, the Fed and all the members of the Fed are going to look really silly. Well, because I think the arguments are much more nuanced than they made them. And the question is, the right question is, well, if the tools don't apply to the supply side, and this is all driven by the supply side, why do you think that tools directed at the demand side are going to work? So
Danny,
I thought this was mishmash.
I've got a negative statistic on GDP. Granted, it's a first look and such. Right. Deutsche Bank has formalized at end of 23 with a recession call. We need to recalibrate your concern about economic slowdown. Given this discussion today, and particularly the Powell discussion of what I'm going to call a fungible neutral rate, how close are we to a true NBER contraction?
Well, my view is if you take the consumer confidence data, it predicts recession in Europe, recession in the United States, recession in the UK, and recession in Japan. Now, you can say it's not going to happen, and Powell sort of said, oh, well, let's hope the consumer doesn't kind of respond to this. It predicts it. Now, you can deny it. You can say it's different because the labor market's different, but to actually sort of ignore it strikes me as extremely foolish. So what the Fed has done is it's put themselves in this 1974 thing where it sort of thinks that if the wage inflation is going to go to 10, but that's of the dream world. That's not where we are. He talked about nominal wage growth. Real wage growth is strongly negative. I see. So really, where are we? I mean, I think we saw 2015 to 18 was a mistake because they misunderstood the nature of the labor market. But I think the argument is much more nuanced. All the questioning was as if we knew exactly what was going on. We know there's been an oil shock. We know the demand's too high. There's a roaring labor market. So we just raised rates and there'll be a soft landing. Utter gibberish. I think that arguments are much more nuanced than that. We can have significant debate about it. I certainly said this morning in an interview on the BBC, if I was on the NBC, I would be voting for rate cuts now.
Danny, you cited President Lagarde. I just want to bring our audience a fuller quote from President Lagarde. Here it is. Demand here in the Eurozone is pretty much back where it was pre-COVID. In the US, it's up 30%. Ask yourself why. Because of this massive fiscal stimulus that the US economy has had, unlike the Eurozone, where it's been more moderate, not excessive. She's referred to what's happening in Europe as a different beast, not the same beast as the United States. And let me go one step further. We just had the ECI. I'll finish, and then you can respond. Wait a second, Danny. You know how this works. The ECI data came out in the last week as well. Absolutely surged. The reason people are in that news conference asking about rate hikes is because unemployment is at 3.5%, set to be down there on Friday, just above it right now. Inflation's at 8.5%, and they were at 25 basis points, Danny. Why is that not the logical question?
Well, the first thing is that consumer confidence in both places has collapsed. Both in the US and in Europe, it's collapsed for whatever reason. Maybe the depth of the recession will be different. The second thing is it's absolutely clear that the unemployment rate is no longer an adequate indicator of market slack. So if you run a wage equation, the unemployment rate doesn't enter into the wage equation. Things like the employment rate and underemployment rates actually do. But let's remember, what you just said was exactly what people were saying. In August 2008, September 2000, inflation's really high and everything's going hunky-dory. And what we realized then was the US had been in recession for 9 months. So at turning points, data gets turned down, and you can always say everything's fine. But the problem for a central bank is you don't know where you've been, you don't know where you are, and you don't know where you're going. And the central bank I've just listened to asserted that it knew where it had been, it knew where it was, and it knew where it was going. But the world is much more uncertain than that in the world of supply shocks, war in Ukraine, fifth sweep maybe of the pandemic. This is a very uncertain world. So the right thing to do is to balance your risks and look at the alternatives that are out there. I just think this was a very dangerous press conference where he asserted as if he knew he was standing in 1975 and wages were going to explode and they were going to fix everything and there were X rate rises coming. I thought that was absolute nonsense.
Danny, in fairness, they've gotten inflation wrong. They underballed it, they lowballed it. They expected it to rise surprised.
price hike shock.
I'm just wondering,
The price
though.
hike shock.
But Danny, I'm
Right.
just wondering, though, going forward, when are you going to know if you're wrong, right? I mean, like, let's say, for example, inflation rates do not go down below 5% by the end of this year. Will you reassess your view that we are not 1970s?
Of course. But I think, yes, absolutely. But I'm going to look at the data and track the data and see what happens, allowing for the possibility, that I could be wrong on the inflation front. But it doesn't seem that the Fed is actually thinking what would happen if some data came in that was horrible. But the reality is that inflation spikes up and then it comes back down again. Now, obviously, the spike up has been more than people thought, but the supply shocks have been there, pandemic's been there, war in Ukraine. Remember that if you run these forecasting models, you have no prior data to tell you. You have no data which tells you what's going to happen to inflation. I don't know what's going to happen, but the Fed has just asserted that it knows that it can raise rates. That will be a soft landing and all will be fine. They know no such thing. They have no models that do any of that. So they're just winging it. I hope they're right, and maybe that I'm wrong. That could possibly, of course, be true. But the assertion of the degree of certainty, I was really struck by. Singing from the same hymn sheet, and our tools don't work on the supply shock. Oh, well, what if this is all driven by the supply shock?
Okay,
they're in for a big surprise.
Danny, I hear your point. I take your point about the supply shock issues and their inability to really address that. But there are some issues in this market very much driven by policy. I'm thinking of the housing market. I'm thinking of rents that are following how much dynamism there's been in that housing market. How do you justify turbocharging it at a time of economic growth, given the fact that it is essentially a tax on the least wealthy individuals in this economy?
Well, I read the data. I mean, I've done lots of work on this. So the question is, how much does a 1 percentage point rise in inflation hurt people compared to the alternative? It's not as if, this hurts people and we're going to do something which doesn't hurt people. Clearly, that inflation hurts. We know that. The ultimate question the Fed has to ask is, I'm going to lower inflation by X points, and that will improve people's well-being. And then we're going to create something as an alternative which may be okay, may be better, but all the evidence is a 1 percentage point rise in unemployment, which presumably is going to come. The question is by how much. It's about 5 times worse than a 1 percentage point drop in inflation. So, 1 percentage point rise, drop in inflation is much less than reducing unemployment. So it's not that I'm saying inflation doesn't hurt. Of course it does. But the Fed is asserting, without any evidence, without any data, without any adequate models, that they can reduce inflation without creating something that's worse. And all the evidence is that when they've done that, they've created recessions, which raises unemployment, which makes things worse.
We're going to have to leave it there.
I'm a data guy.
Professor Blanchard, thank you so much. We're going to have to leave it there. And I'd remind folks of Diane Swong's comment earlier about a 5% unemployment calculation to get the agony out to suppress inflation. We will see on that. That's part of the debate. The debate is in the market. John, I want to do a data check here before Jeff Rosenberg. I think it's so important. Stocks are up. John, I just did a fancy pro Fibonacci study of this rebound, and I want to reiterate, John, that part of this shocking rebound was how depressed equity prices were going into this press conference on any kind of moving average or Fib study. I'm sorry, we're not even back to the 50th percentile right now. We were depressed, John.
I didn't get a chance to thank Danny, so thank you, Danny. We've been friends a long time. There's nothing personal going on there, just in case anyone was wondering. Up 2.8% on the S&P, Tom. This is quite a squeeze. And in the bond market, it's a big move too. I think this bond market tells you more about how we were priced today than about where this Fed is going, down 12 or 13 basis points.
I agree with that strongly.
Coming into this, the number one market question was 75. Would you go bigger than 50? He's left 50 on the table for the next meeting, 50 on the table for the meeting after that. And I'd say 3 months ago, let's say we started the year, and I said, let's say in May, you'll get a dovish 50 basis point hike, and he'll communicate a 50 basis point move after that and another one after that, and it'll be dovish on the day. It just tells you everything about how much we've priced over the last month, and we priced a lot.
That's a script as we see it. Let us get a pro to discuss this right now for Global Wall Street on Bloomberg Radio and Bloomberg Television. Jeffrey Rosenberg joins us of BlackRock and, of course, their portfolio manager. Jeff, you're smiling, you're grinning here on Bloomberg TV and radio this morning. To John's good point, is this a bond market in somewhat of a squeeze or a convexity, a gamma move where they're moving away from the bet made a day ago, or is this a bond market gaming out the future for Jerome Powell?
Well, it's a really interesting discussion to listen ahead of the last guest that you had when you guys were talking about, kind of when did the market really take off? And, as I was watching it, yes, it was the answer to the 75 basis points. But then, Tom, you came back and talked about the thing that followed that. And that was, I think, even more important than the 75 basis point kind of dismissal. And that was discussing, where is neutral?
Yeah.
And you look at what was in the prepared statement versus what did he say during the press conference, Q&A. What he wanted to get across was in the press statement. What he unscripted answered, which I think is, maybe not what they were intending to have occur, was the answer to where is neutral. That wasn't in the press statement. It wasn't in the prepared remarks,
totally.
But it definitely fueled the rally because the answer was 2 to 3%. And if the answer is 2 to 3%, right before this meeting, the bond market is pricing 270 by the end of the year. So, wow, we're pretty much there. And the Fed just told me they're pretty much done, and the bond market's pretty overpriced, and that's what fueled the rally.
Jeff,
Except I'm not sure they wanted that as the outcome.
Okay, this is critical because you're out of Tepper, Bennett McCollum, Alan Meltzer, Marvin Goodfriend, and what you're saying, Jeff Rosenberg, is lose the mathiness and just look at the probabilistic guesstimate of neutral, and we don't know where that is. Jay Powell doesn't know where that is does he?
He doesn't, and the market doesn't know where it is, but the market was pricing that degree of get to neutral pretty much completely, and he kind of unintentionally reinforced the notion of, oh, we're there. We've got everything this Fed is going to do, and it's priced in. And the reason why I say that might be unintentional is because the other thing, and I wrote it down and underlined it during the press statement as, oh, that's new information, because he said 50 basis point increases in the next several meetings. I don't know if the words are exactly right, but you know what I'm talking about. And that was new, right? Because we're only really talking about 50 for this meeting, 50 for June, maybe further out, but the market wasn't pricing a sequence of 50 basis points. And he reiterated, in the answer to the credibility that they like the expectations channel of monetary policy. They want the bond market to be pricing for them. It does a lot of work. So it was intentional that they made that statement about 50 basis points are on the table. That was, I think, intended to be like, let's keep this pricing up. Let's keep the bond market expecting these kinds of hikes because it does a lot of work for us. But I think he may have misspoke when he answered 2 to 3, and he gave instead a big easing in financial conditions, at least for today, maybe unintentionally, when as the intention was let's keep the expectations high here on what we're going to do.
Are you suggesting there's a cleanup act still to come, Jeff, and the Fed speak over the next few weeks?
Look, could be. This is all kind of inside baseball of the immediate reaction. Let's get away from that for a second. What really matters here was the other, I think, really important point that they were trying to emphasize, that they are trying to say that there is no, he said it explicitly in the answer to the question, there's no conflict here between the labor market and inflation. Inflation is the objective. You cannot have a sustained period of labor market benefits without price stability. So that's an important kind of hawkish message, kind of lost in the market reaction. And whether or not they need to do that, really, we don't know. The Fed doesn't know, the market doesn't know. There's a forecast that inflation is going to come down, but it is going to come down to whether or not that inflation forecast indeed shows up or not. And if it doesn't, as the questions were asked several times, he was very clear to say, we're going to act on the side of inflation. The era of running the economy hot for broad-based inflationary gains, there was a question on that with regards to the dispersion in unemployment rates. He batted it aside and he said we need price stability for everyone to benefit. And that, if we don't get the price stability, is setting the Fed up to set the people up, the market, and speaking directly to the people here, that we're on the side of fighting inflation. There was a very nuanced use of the word sustained employment in the statement. Again, that you may not have persistent 3.6 unemployment rate to rise a little bit, room for tightening in labor markets. He's saying without recession they can get there. Yeah, that's a narrow path, but of course he's got to say there's a path. He's not going to say, well, yeah, we're going to cause a recession. Of course he can't say that. He's got to say there's a path. They got to hope for that. But it's really going to come down to that evolution on inflation. And they're scared, and he highlighted how they shifted was because of the broadening of inflation. And that's still the case, and it's still to be determined whether that broadening of inflation really shrinks down to the market and FOMC consensus forecast that it will.
If you're just tuning in on TV and radio, maybe you've been hiding under a rock for the last 3 months. The Federal Reserve just hiked interest rates 50 basis points, and the Nasdaq's up almost 3%. We did a lot of work over the last few months if you missed out on all of that. The S&P up 2.8%. Bramo, I don't know what it is about Fed decision, price action, but the Nasdaq on March 16th was up 3.7%. It's up 2.9% now. Jeff, for market participants, they're just going to be wondering, okay, Jeff, I hear you. I got all that. I understood it all. What do I do now through the rest of the summer? Now the chairman has pretty much validated a 50 basis point move in the next meeting and another one after that.
Yeah, well, I think we're going to be watching, as we have been expecting before this meeting, the path of the monthly inflation statistics. I think there's a lot of other noise around that, the supply side that they can't control. But you take that ECI number from last Friday, that was a big number. And you take the JOLTS data earlier this week, and you did not see the slowdown in the job openings. So there's a big presumption in here. He stated it in the press conference that the supply side will help to ease the labor market tightness. So we're going to need to see that show up. We're going to need to see the impact of that in the measurement of wage inflation. And we need to see the lessening of the effects of the broadening of inflation. If we don't see those things, which are all very much the consensus expectation, including for the FOMC, that we will, then if we don't, then it's a different path, and the Fed is saying we will take that additional path. And that's the path not to neutral, but the path to restrictive. We're not priced for that path, and that will be determined by something we can't forecast, but we will all be laser focused on, which is that near-term succession of inflation incoming data.
Jeff, is there anything in this report or the press conference that would actually cause you to change your trade or actually to trade actively?
We're not super high frequency, short horizon traders on this. Clearly that's what's going on. You're looking at, there was a lot of high frequency trading around the data. But again, the step back for me is, I think they were trying to send a message of sustained expectations for 50 basis points, the possibility of further 50 basis points. I think they unintentionally gave a very dovish message. And yes, there is some room there on the 75 basis points. Markets may have been overly priced and overly hawkish. You get that kind of immediate reaction. But outside of that, there's not, really new information. The new information is still to be received in terms of the development in the economy around inflation.
Hey, Jeff, this was awesome. Thank you, buddy. Jeff Rosenberg there of BlackRock, just breaking down some big moves. And we have some big moves this afternoon. Up by 2.8% on the S&P 500. On the Nasdaq, up by 2.9%. Yields lower, much lower, particularly at the front end off the back of these comments from Chairman Powell on that 75 basis point move that he just batted away. Down 14 basis points on a 2-year to 263.80. Saw some strength in the dollar over the last few months. Since the last meeting, the dollar index stronger by about 5 percentage points. Today, negative 0.7%. If you want the sector breakdown of what's been going on in this market, Tom, top of the pile, energy. The energy sector up by 3.8%.
Yeah, 111 rounded up on Brent crude, and I would say that's a separate beast, John, to what we're seeing. And again, with Javier Blas really focused on the distillates and diesel as well. John, I can't emphasize enough how depressed we were, say, looking at equities and how, yes, we've exploded higher, Nasdaq 3.2%. I did a fancy study. The SPX is not back to the 50% mark on 2 standard deviations. So depressed and a huge pop up. And as Ira Jersey just published, now what seems to be really important.
Final word, Bramo. What are you thinking?
That we're trading tail risks. That seems to be this market. We're looking at what the potential outlier events might be, the 75 basis points being one of them, and that's what directs all movement.
We haven't set the tone on Fed Day for the month afterwards, have we?
No.
We didn't do that last time around. So I'm hesitant to read too much into this 3% move, Tom, on the Nasdaq we're seeing this afternoon.
Exactly. But do I get a final thought?
Of course you do.
Bramo does, but
yours are usually longer and they go on for a while and they're often off topic, like the one that's about to come, of course.
Is, you know, playing a cautious game against Real Madrid.
Was that a productive use of time?
It was, yes.
Tom Keane, Lisa Bramett and Jonathan Farrow. For our audience worldwide, if we still have one, we'll see you tomorrow.
We do this
on
tomorrow.
Bloomberg Surveillance. I cannot wait for tomorrow morning, Tom. 3 a.m. alarm, waking up with you again, coming in here. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell. Recapping, resetting on this Fed Wednesday. What a day for the U.S. equity market. Right now, we have got the S&P up 118 points. That is a rally of 2.84%. The Dow up 905, a gain there of 2.7%. Nasdaq surging 376, up by 3%. 10-year yield right now, 2.91%. The Nasdaq 100 index up by 3.2%. Stocks rallied. Treasury yields fell after Fed Chair Jay Powell eased concern that the central bank will embark on a more aggressive pace of monetary tightening after delivering its steepest rate hike in 2 decades. What sent stocks ripping higher was this statement from the Fed Chair.
75 basis point increase is not something the committee is actively considering. Assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings.
And with more on today's Fed decision, here's Bloomberg's Vinny Del Giudice.
Fed officials say they're highly attentive to inflation risks as household and business costs rise at the fastest pace in 4 decades. They also say they're far from done, that it could get ugly and rates will go even higher. And effective June 1st, the Fed will start cutting the size of its $8.9 trillion balance sheet as part of its aggressive tightening campaign. The Fed loaded up on government bonds during the pandemic to help keep a lid on rates as the economy recovered. Vinny Del Giudice, Bloomberg Radio.
And again, we do have the 10-year yield, 2.92%. Spot gold up 0.8%, 18.83 the ounce. West Texas Intermediate crude surging 5.5% today, 108.02 a barrel. Briefly, Intercontinental Exchange is buying Black Knight in a deal valuing the mortgage software provider at about $13.1 billion. Black Knight shares surging 13.6%. Intercontinental down now by 4.7%. After earnings, Lyft is plunging 29%. Rival Uber is down by 4.6%. Recapping, S&P up 2.9%, 10-year yield 2.92%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is the Drive to the Close, live from the Bloomberg Interactive Brokers studio in New York. Good afternoon and happy Fed Day to our audience around the world. And watching us on YouTube, it's Bloomberg Business Week. Tim Stenevec here. Carol Massar is off today. Joining me is Bloomberg Senior Markets Editor Mike Regan. Mike, let's get right into it with Brad McMillan. He's Chief Investment Officer at Commonwealth Financial Network. He joins us on the phone from Waltham, Massachusetts. He's got approximately $232.5 billion in assets under management. Brad, give us your takeaways from what we just heard from Fed Chair Jay Powell, because I got to tell you, the equity market is loving it.
And they should. I mean, I'm sorry. The real message here from Chair Powell is we got this. The Fed is under control, and we see the economy growing. We see the inflation. We're doing what we need to do, and we're going to continue with the path, and there's a plan. And the market loves a plan.
Brad, it's Mike Regan. There seemed to be just a spike higher in equities and risk assets. Right around it was like 240, 242. There were a few remarks of Powell's right around that time. I'm curious, what do you think really lit that fire? There was some remarks where he basically said we can still attain a soft landing, but he also said they've pretty much ruled out a 75 basis point hike. Was it sort of the 1-2 punch, do you think, or do you think it was one or the other? I guess some people really were worried about the chance of a 75 basis point hike. What do you think really is driving this rally? We're looking at 3% now up in the S&P 500, just eye-popping gains.
Well, as I said, I really think it comes down to, does the Fed have a handle on this? And Powell, rightly or wrongly, conveyed a strong sense that they see another couple of 50 basis point hikes, which is in line with, yes, we're going to get inflation under control, but it's not so far out of control that they need to get crazy. I mean, the real message from a 75 bip hike would have been, wow, this is a crisis. We've really got to do something. So I think that sweet spot, between doing enough and not having to do too much is what the market sees right here.
Go ahead, Mike.
Yeah, Brad, I'm wondering, do you think this sort of embrace of risk today in the market, is it kind of counterproductive to the Fed's goal to tighten financial conditions a little bit to, as a way to tamp down inflation? Is this kind of maybe not the outcome Powell would have hoped for going into today, do you think?
I actually think that makes a certain amount of sense, but given the amount of decline we've seen in the asset, over the past couple of months, I don't think it's going to worry them too much. I also think that this kind of a relief rally, after the worries we've seen, is probably see valuations start to move back up. That's when I think the Fed is going to start to worry about the market. But I think today, the Fed's reaction is going to be let them have their fun. They've earned it at this point.
I thought it was really remarkable, Brad, the way that Powell opened his press conference, speaking to the American people, saying that he understands that inflation is too high, that he understands the pain associated with rising prices. Brad, what did you make of that?
I think there's two things here. First of all, I think that the Fed is in a difficult place politically. They've been seen as perhaps not being as sensitive to the needs of the average person. And I thought Powell made a very good case that what we're doing actually is aimed at helping the average person. And he came back to that again and again throughout the press conference. I think the Fed is trying to build the political base for what might actually turn out to be a difficult campaign against inflation. As an example of that, one of the people asked, what does this mean? Are you willing to create a recession like Volcker did? And Powell's answer was interesting. He basically said, yeah, we'll do what's necessary. But you can't do that, and you can't hold on to it without that political backing. And so I read that as kind of a preemptive strike on the Fed doesn't understand the little guy.
Brad, in addition to stocks, just an eye-popping move in the Treasury market, too. I'm looking at the 2-year yield. It's down almost 15 basis points. 10-year yield is down a lot. Do you think we've seen the worst of this steady march higher in interest rates, or is there really more room to go for rates to go higher, do you think?
I think we've about topped out. And the reason I say that is the last time we saw a rate hiking cycle was in, obviously pre-pandemic, and things topped out about 3%. Now, right now, obviously, we have much higher inflation, but there's also signs that's starting to top out as well. And there's still a tremendous amount of demand for long duration U.S. Treasury assets. So I'd be surprised if we didn't start to see things back off. Maybe as the number of expected hikes goes back, we see rates start to roll over a little bit as well as we start to price in more rate cuts in the next couple of years. I can't see it pushing too much higher than where we are.
Brad, I did think that Fed Chair Powell's comments regarding the blunt instruments that the Fed has and that they're not precision tools were pretty remarkable. Specifically, the part about him not being able to control supply side elements, supply chain issues, effects of war on commodities. He specifically said that the Fed can't do anything about commodity prices or snarled supply chains. What can the Fed do to bring down prices there?
Well, I think, once again, this is kind of a combination of educating the public and laying the political groundwork for what could be a difficult campaign. I mean, what the Fed can control is how much it costs to buy stuff here in the U.S., cars, houses, and that's going to hit the average person. But that's not going to show up in the price of gas. So the question becomes, if you're an average person, what am I suffering all of this pain for? And to be able to do that, to make the Fed as little of a punching bag as he can, he needs to get the average person to think, yes, I understand where this is coming from. And part of that is acknowledging what he can't do. Again, I think it's a preemptive strike against what's sure to be political attacks as we get into the midterms.
You know, Brad, speaking of those commodity and energy markets, the other big story today is just a huge rally in oil. This is coming as the EU is threatening to completely ban Russian supplies. Some of the U.S. regional fuel inventory data showed drops to record lows in some cases. Looking at West Texas Intermediate oil up 5.5% to over $108 a barrel. To bring it back to that equity market, obviously energy shares have just been far and away the best performing sector among the main ones in the S&P. Really the only one with a steady positive gain this year, 30-some% for the group. Is that play still in place? Do you think, is energy poised to really continue that outperformance? Do you think as long as this Russian-Ukraine situation continues?
I do think it's poised to continue the outperformance for two reasons. First of all, the supply situation, the world has changed. It's different this time, and I never say that, but it really is. You know, you have a very significant exporter off of the market, and depending on whether or not that does damage to their infrastructure, and there's reason to believe it will, that might be off for years. So the supply situation has changed significantly, and the other significant thing that I don't think is getting enough attention is U.S. drillers especially are showing a lot more capital discipline than they've done in the past. In other words, they're not just going out and going crazy and drilling. They're actually managing their capital expenditure. So we're not going to see the kind of explosion of supply.
Right. Brad,
so
we gotta leave it there. Brad McMillan, Chief Investment Officer at Commonwealth Financial Network, joining us on the phone from Waltham, Massachusetts. Well, just a couple of minutes until the markets close here in the U.S. The Dow Jones higher by 2.8%. The S&P 500 off of session highs, but still up 2.9%. The Nasdaq over 3% higher right now. Coming up next, it's Beyond the Bell, our cross-platform coverage of the market close with our colleagues from Bloomberg Television. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Riggs, and Katie Greifeld counting you down to the closing bell here on this Wednesday afternoon. And here to help take us beyond the bell, it's our global simulcast. We're joined right now by Tim Stenovic and Mike Regan. We welcome our audiences across Bloomberg Television, radio, and of course on YouTube. And Tim, looking at this rally that we have in our hand, 3% move on the S&P and the Nasdaq after we got a 50 basis point hike by the Fed.
Yeah, less about the 50 basis point hike and much more, I think, about taking that 75 basis point hike off the table. S&P 500, best day in just about 2 years, Mike.
Yeah, Tim, I also want to take a quick look at currencies because, wow, did they really move after that Fed press conference? Looking at the Australian dollar, up 2.2%. That on a closing basis is the biggest move for the Aussie dollar in more than a decade. But really gains against the dollar against all the major currencies. New Zealand dollar's up 1.7%, Norwegian krone up more than 1%. So to me, it sort of begs the question that if Powell is trying to sort of tighten financial conditions, a weaker dollar is kind of counterintuitive to that goal. So Taylor, I wonder if this was a little bit of against what he was hoping to accomplish.
Well, some similar statements. Katie, of course, if you think about the real yield, which I know that we had seen a huge jump up out of negative territory up to 15 basis points. The 10-year real yield sort of declines back to about 4 basis points. So in that case, perhaps more of that easing that Mike was just talking about of some of those financial conditions.
Absolutely. You think about what the Fed is thinking right now. Probably not thrilled to see financial conditions actually ease a bit here. VIX, too, down back to 25.
And this is a huge rally underway. I know it is only one day and sort of digesting further comments, but we'll bring you the one-day moves. As we've been mentioning, you have an S&P 500 that is closing up on the dot 125 points, 3%, the biggest one-day rally that we have seen since about May of 2020. Technology is also a big outperformer. You're up 3.2%. The Nasdaq 100 is up 3.4%. But that rally is only the biggest going back in about a week. The last time it was up about 3.5% was just over a week ago. So really interesting volatility that we have underway. The Dow remained, we will quote this because it is almost 4 digits, 930-point increase here on the Dow, up about 2.8%. Let's zoom out as well and talk about the Russell. It's actually the marginal underperformer on the day, despite the focus on the reflation, inflationary, domestic focused cap stocks. Typically, you would see sort of a big outperformer, but on a day, Katie or Tim here, when yields are falling, that actually makes sense a little bit. But huge sort of relief rally when it comes to some of these long duration assets.
Yeah, that relief rally really broad-based too, Taylor. 30 of 30 stocks in the Dow Jones Industrial Average higher today. In the S&P 500, only 25 stocks lower, 479, Katie, higher on the day.
Yeah, Tim, and really breadth is remarkable here. Take a look at the sector level. I have a lot of green bars to show you. Right up at the top, you have autos. A lot of that is Tesla. You also have energy, semis, tech, all together rallying, pushing this market higher. Sort of an odd pairing on the sector level, especially when you consider yields down today, but quite a lift for the cyclicals. And of course, worst performing is a relative term here, but you do have real estate down at the bottom, but still up over 1%, Taylor.
Let's talk about that yield space. It is unbelievable when you think about a 2-year yield on a day when Jay Powell said perhaps maybe 75 basis points is off the table going forward, maybe not in active discussions, but certainly talking about 50 basis points or so in the next couple meetings. A 2-year yield that declines 15 basis points to a 263, a 5-year down 12 basis points to a 290, a 10-year at a 291, a 30-year though still at a 3%. So certainly a re-steepening, Tim, here of sort of these 210s, 230s yields curve that is underway.
Well, let's go back to that moment during the press conference that really moved the bond market and the equity market when Fed Chair Powell said that 75 basis points was pretty much off the table. Check it out.
75 basis point in an increase is not something the committee is actively considering. Assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings.
Chairman of the Federal Reserve, Jerome Powell, just now. I will note that he did continue to say we're going to make those decisions at the meeting, Romaine, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as the financial conditions. So some caveats there.
Okay, I mean, can we get something straight? Is he driving the ship here? Because remember, we had a 25 basis point hike at the last meeting, and he basically told us everything was fine then. Look, I understand the communication. I understand why you would talk down a 75 basis points being on the table here. But at the end of the day, the Fed isn't driving this ship right now. Inflation is driving this ship. And if inflation is still out of control by the time you get to that June meeting and then to that July meeting, I guarantee you 75 basis points will be back on the table.
Yeah, Romaine, and well, I would just want to point out what a sort of surprise this was today. If you look at the VIX, down more than 4 index points, that's actually the biggest drop for the VIX this year. The next biggest one we saw was in December 7th of 2021. VIX back to about 25. So, Katie, really a lot of hedges
is the negative re-rating over, Mike? Is the big re-rating lower that we had, where everyone said valuations were too high in the face of rising rates? What's changed right now? Did the neutral rate change? Did the target for the neutral rate change, either based on what the Fed is saying or what the market is pricing in? Whether you get there in 75 basis point increments, 50 basis point increments, or 25 basis point increments, it seems like we're still headed towards the same place that we were a couple days ago.
I think that's true. I mean, I think the relief today is just that they're not going to try to get there quicker and, you know, at a really hasty pace, the way that some people were sort of worried about with that 75 basis point increase. Katie?
Well, if I could jump in here, we actually have a lot of news to get to because earnings season is still rolling on. We do have reports out from Booking Holdings. First quarter revenue was $2.7 billion. The expectation had been for $2.5 billion, so a beat there. You also had the CEO say that rather the bookings on Booking were quite large. If you look at shares after hours, they're up 7.2%, so quite a beat there. First quarter room nights sold 198 million, stumbling over the words here. That is above the estimates as well. If you look at, again, all of these different inputs, it looks like it was a beat across the board so far.
And the booking, of course, seeing that first quarter, a record for the company's history. They're really preparing for a strong travel season. As, of course, on this Fed Day, we're really taking a look at the consumer, the health. And yes, even with inflation, people are still traveling. You get a similar sentiment with TripAdvisor, seeing that first quarter revenue also coming well above expectations, 262, Tim, versus estimates of 250, and also naming a new CEO, replacing sort of the co-founder, originally Matthew Goldberg, of course, set to succeed here starting in July. So you're seeing sort of a renewed passing on the baton, if you will.
Okay, well, I'm watching shares at eBay because the company just reporting results. It's a miss when it comes to guidance for continuing operations, 87 cents to 91 cents. Estimates were for $1.02. The company sees net revenue in the second quarter from $2.35 billion to $2.4 billion, so a miss on the top line too. Estimates were for $2.53 billion. The company maintaining its quarterly dividend at 22 cents a share. Shares right now in the after hours are down, Taylor, about 6.6%.
And we'll just say, sort of wrapping up these comments here, when you think about CEOs, they've been maybe a little bit cautious in some of this forward guidance, but really highlighting the health of the consumer, and that's echoing comments from Jay Powell. It's a tight labor market. Consumers have seen wage gains. Yes, of course, some of this has been eroded by inflation, but it doesn't show any signs here, Katie, that there is a massive sort of drop-off in the consumer, and you would argue that some of these big reopening trades are indeed reflecting that.
Absolutely, and if you think of the earnings that we've gotten this week from those travel stocks, I mean, we had Airbnb, Expedia, and now Booking. They all point to this same picture, which is that pent-up demand for travel, for these experiences. So again, that just wraps into a consumer that has been really, really resilient so far.
Yeah, and obviously this is going to be the real key going forward as we keep an eye on those inflation numbers. It really is about consumer spending. I'm not sure what's going on with eBay. I feel like that's sort of an outlier there. But when you look at some of the other e-commerce stocks, even though they got beaten up, I know, after the Amazon earnings, you sort of wonder what place that consumer spending is in right now, Taylor.
Well, you could have perhaps maybe see some downside to that, Romaine. I know that you love and you're a big user of Etsy, and unfortunately seeing a huge miss when it comes to gross merchandise sales. You're getting a big miss.
Tell Elon Musk not to buy Etsy.
Second quarter revenue only.
How about that? And reunite it with PayPal and all come full circle.
Everything old is new again.
Oh, boy.
Hours of programming I just gave you right there.
Yeah,
Hours.
Etsy second quarter revenue doesn't look good. They're looking at 540 to 590 million. Estimates were for about 630. Adjusted EBITDA margins way down to 25 versus estimates of 26.5%. So, Tim, this is, of course, on the side where you could actually wonder about perhaps maybe some of the execution here.
Yeah, that's a really good point. I want to end on what I thought was a pretty sobering moment from the Fed chair's press conference. He started by speaking directly to the American people and talking about the pain of inflation. This is not something that's something that affects the American people, obviously, but when it comes to what the Fed says, the average American is not necessarily paying attention, and he clearly wants to get that message out. We are out of time, guys. Romaine, I'm going to have one question for you. Are you ever going to come back from sunny California? Are we going to see you this week?
No, you were just out here. How'd you get home so fast? And where's Carol? She took the day off?
Yeah, she took the day off.
Okay. I might show up tomorrow. It depends.
All right, we'll
see.
Game day decision. Well, safe travels. Enjoy the rest of your time out there. That is going to do it for our cross-platform coverage of Beyond the Bell. We will see you tomorrow, same time, same place on Bloomberg TV, Bloomberg Radio, and YouTube.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Mike Regan live from the Bloomberg Interactive Broker Studio in New York. Quite the rally today for the S&P 500, for the Nasdaq 100, and for the Dow. The S&P 500 finishing higher by 3%, the Nasdaq Composite higher by 3.2%, and the Dow higher by 2.8%. Let's get to Nancy Lyons in Washington, D.C. for a check of the latest world and national news. Hey, Nance.
Thanks, Tim. President Biden says the Republican Party is the most extreme it's been in recent history. He says if they gain control of the Senate, it could result in Social Security, Medicare, and Medicaid being reviewed every 5 years. Biden says his administration has proven to be the fiscal conservative, especially when it comes to deficits.
All the talk about the deficit from my Republican friends, I love it. I've reduced it $350 billion in my first year in office. And we're on track to reduce it by the end of September by another $1.5 trillion, the largest drop ever. I don't want to hear Republicans talk about deficits and their ultra-MAGA agenda.
Biden says reducing the deficit is a way to ease inflationary pressures we're seeing. An investigation is being conducted into the leak of that draft Supreme Court opinion overturning the Roe v. Wade decision on abortion. Columbia law professor Catherine Franke on who might be behind the leak.
There are plenty of people who work at the Supreme Court who, if a document is sitting around on a desk, would have access to it. I suppose there's a possibility of a breach of the security of the email or the computer systems at the Supreme Court, which is probably less likely.
Franke says she does not see the leak as a crime, but does believe it would end the person's career. A federal judge is accepting the plea deal for Derek Chauvin, the former white Minneapolis police officer convicted of killing George Floyd. Chauvin will be sentenced to between 20 and 25 years for violating Floyd's civil rights. He's already been convicted of murder in his death. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons, Tim Stenovic, and Mike Regan, senior markets editor here at Bloomberg, joining us live from the Bloomberg Interactive Broker Studio in New York. I do want to go back to the big news of the day, Mike, and just get your continued take on what we heard from Fed Chair Jay Powell and what we heard from the Federal Reserve, unanimous in its move to raise interest rates by 50 basis points.
Yeah, I think it's all a matter of the expectations game, and the rhetoric from so many speakers at the Fed has been so hawkish that many in the market had really been looking credibly at the possibility of a 75 basis point hike. Probably not today, but at some point in this tightening cycle. So I think Powell taking that off the table more or less, never say never, but he made it sound very unlikely that they would ever do that, allowed for the sort of relief rally for this, the market to exhale. I think there's a lot else going on, though. Just the fact that markets were so weak in the past week heading into this event, really S&P flirting with that and actually setting new lows for the year after that ugly day on Friday. So, it's common to see, a snapback rally at some point after a day that ugly and as the market's testing new lows like this. And I think that's important to keep in mind, the fact that, this rally today isn't necessarily an all-clear signal. Bear market rallies can be really fierce and strong, and we simply just don't know at this point whether that's what we're looking at today or whether we really did set a bottom.
Well, just in the last 30 seconds that we have with you right now, I'm wondering about communication here, because it seems like Jay Powell and company have done a really great job of setting clear expectations in the weeks heading up to this meeting.
I think so. I mean, they're still sort of trying to shake off their communications from last year when they said inflation would be transitory, but clawing back that credibility little by little for sure.
All right, we're going to have much more to come on everything that just happened with the Federal Reserve and all things Jay Powell. We'll also talk travel with Axel Heifer, the CEO of Trivago, in just a minute. This is Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A Fed Wednesday big move higher for the U.S. stock market. Lots of earnings. Among the names reporting after the bell right now, Booking Holdings. More people aren't traveling. That is great for the online travel agencies. Booking reporting revenue for the first quarter that beat the average analyst estimate. Its brands, by the way, do include Priceline, Kayak, and OpenTable. Shares after hours of Booking up by 7.5%. Stocks rallied. Treasury yields fell after Fed Chair Jay Powell eased concern the central bank will embark on a more aggressive pace of monetary tightening after delivering its steepest rate increase in 2 decades. Today we had the S&P surge 124 points, up 3%. The Dow rallied 932 points. That was a gain of 2.8%. Nasdaq up 401, a gain of 3.2%. 10-year up 14.30 seconds. 10-year yield 2.91%. Spot gold up 0.8%. 18.83 the ounce. West Texas Intermediate crude up 5.30 a barrel, now at 107.71, up today by 5.2%. So again, recapping, stocks up the most since May of 2020. S&P up 124 points, up 3%. 10-year yield 2.92%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Tim Stenevec and Bloomberg Senior Markets Editor Mike Regan, live from the Bloomberg Interactive Brokers Studio. Mike, of course, we are still focused on what we heard from Fed Chair Jay Powell. I want to go back to something that you said during one of our breaks about we're not quite out of the woods yet when it comes to the markets. And you did refer to the idea that we saw some intense selling last week, so the market was sort of primed for a rally like this. What derails the Fed's plan of 50 basis point rate hikes in the next few meetings?
I think it's really, you get back to the Fed's 2 mandates. Inflation obviously is what they're focused on now. But if they were to see weakness in the other mandates, which is the labor market specifically, that would really be one thing. And I think really nasty action in the financial markets, drop in stocks, that rising dollar, real volatility, credit spreads blowing out, that sort of thing. They look at those financial condition indexes, which sort of aggregate all the markets at once to try to determine whether conditions are getting better or tighter in financial and money markets. So, a little bit of a drop in stocks that we've seen, and it's obviously
a little bit, right?
Getting a little bit more than a little bit.
I got to tell you that when we were at Milken, the idea of the equity markets moving, down 15% from January highs, 12% for the year, it almost like the sky was falling.
Yeah, I think you have to just step back, zoom out on that chart, and look, we have just finished 3 straight years where the S&P returned 26+%.
Right, keep it in context.
So just some simple mean reversion would suggest that this could be a nasty year, just to get back to sort of the average returns you're expecting. So that's one thing I always kind of keep in the back of my mind when looking at everything else is, boy, what a run we had. And, if you look at it from a chart, we kind of really broke the uptrend higher than what it was. So, it's hard to imagine that sort of just eye-popping, ferocious rally continuing, given everything that's going on. Not only just the Fed tightening policy, but also just the world getting back to normal. These massive savings accounts of the U.S. consumer getting spent down, corporate balance sheets. They amassed a tremendous amount of cash during the pandemic by sort of hoarding cash, selling debt, not really engaging in a lot of capex and even maybe not being as aggressive with buybacks as they would otherwise. So you sort of had this big pile of cash both on the corporate and the consumer balance sheets that's slowly getting drawn down. And I think that's part of the reason why this inflation isn't as painful as maybe it would be otherwise, is because consumers have healthy bank accounts in the aggregate. Not everyone. Obviously, there's winners and losers of the pandemic and people who are still suffering from the economic damage that we saw in the pandemic. But in aggregate, the consumers healthier, corporate balance sheets are healthier, and that's allowing everyone to sort of ride out this higher interest rate, higher inflation environment for a certain amount of time.
Okay, that is the key caveat there, right? For a certain amount of time.
Yeah.
Well, let's hit on energy a little bit because that part of Fed Chair Jay Powell's Q&A really caught my attention. He did say that the Fed doesn't have the power to control commodity costs, to bring down the price of oil, to bring down the prices of other commodities. And it reminded me that so much is out of the control of policymakers right now. You've got Russia's invasion of Ukraine that's sending energy prices higher. You've got lockdowns in China that are continuing to snarl supply chains. And you've got ships lined up outside of China's ports because some of those ports aren't working like they used to as a result of COVID lockdowns.
Right.
So the Fed chair and the Federal Reserve can raise rates until the cows come home and offload their balance sheet, but they can't fix the problems of geopolitics.
Absolutely. And, and I think Powell realizes that, as you said, he acknowledges that to some degree. And that's why I think, though, they do know that these ultra-low interest rates were arguably left too low for too long. I mean, it's easy for market participants and others to sort of be a Monday morning quarterback and say that. I don't think anyone really had the gumption to raise rates before we absolutely knew that the economy was on solid footing after the pandemic. Jamie Dimon of JP Morgan Chase, the latest to come out today and say, the Fed waited too long to raise interest rates. It's let's step back and be honest. Jerome Powell's in a very tough situation right
He
here.
really is.
I do not envy him of his job, but I think, there is some element of this overheated inflation that is because of low interest rates. So raising rates is obviously the course to go right now.
Right.
I think what will stop him, again, if the employment situation looks like it's deteriorating as a result, and then that's what turns him around.
One day, perhaps, Mike, many years from now, we'll be talking about a memoir that Jay Powell will have written after his time as chair of the Federal Reserve. Let's get a view on the macro environment, specifically when it comes to travel. We're going to speak to Axel Hiefer, the CEO of Trivago. He joins us on the phone via Zoom from Germany. Shares of the hotel search and travel search platform hitting a 52-week low today after the company reported a loss per share for the first quarter that missed the average analyst estimate. Axel, good to have you back with us. Was today's miss, was that all about concern in Europe, and was that related to Russia's invasion of Ukraine?
Not really, to be honest. From our perspective, we didn't miss the numbers. I guess it's very difficult to predict from the outside what the trend is looking like. And there is one of effect that is in the numbers, which is basically a fine from a very old investigation that has been going on for many years in Australia.
Well, Axel, what's your read on the traveler, the health of the traveler writ large these days? Has that demand to take vacations, to take air travel, recovered to sort of the pre-pandemic level? There's a sense that it's even stronger, that there was a big bottleneck of demand for vacation and travel, and that we're seeing even perhaps a stronger impulse to travel. Do your numbers suggest that as well, or is that off?
Yeah, it depends very much which segment of the travel market you're looking at. Generally speaking, we've seen it in the last 2 summers as well. There is a huge desire to get a rest and to break out of the daily routine, even stronger coming out of the time of restrictions and lockdown. So the classical family vacation, going to the beach, going to the mountains, sees huge demand. And if you're strong in that business, you see numbers that are at or above 2019 levels. The traditional city trips where you go to, the Broadway musical, etc., are now slowly coming back. And for that, obviously, we needed the restrictions to be lifted. And then the last segment, the business travel is obviously lagging. And depending on your business mix, you see more or less recovery. But what we see as very positive, that we think that we are now in a situation where we really see fundamental recovery and really a gradual improvement, whereas the last 2 years were very much an up and down.
It does not feel like the business traveler here in the United States, Axel, is struggling. Perhaps it's just because I just got back from the Milken Institute Global Conference, and it was truly back to 2019 levels, for the first time since the pandemic. But everyone I talked to had trouble finding flights to and from, and we've booked some travel in the upcoming months, and we're having trouble even finding flights. And I'm wondering if it's because flights are being managed in a different way. They're reducing the number of them, or if it's because we're seeing a different level of business travel here in the U.S. than you are in Europe.
Yeah, I think you raise a very interesting point. I mean, there is now with the demand coming back, we do experience supply shortages, and there are a couple of factors. There are labor shortages everywhere, and I'm sure you've seen it in hotels, at the airport, security checks, ground handling,
all of the above.
Everything, and so that is reducing the capacity that is on offer. The other thing is that depending on the routes that you're taking by air, there is also less capacity, and I guess the airlines are to a certain extent more disciplined to put in particular long-haul routes again back to service, and have also decommissioned quite a few planes. So again, it depends very much on the destination of the specific trip, but overall in Europe, I would say that that business travel is definitely not back to where it used to be, and given what we are seeing in the US, it is neither. But obviously, it is coming back. Yeah.
Axel, Trivago had a nice string of several quarters of profitability before the pandemic, and then obviously the pandemic in 2022, when it really started affecting travel, sent the company back to a loss. Then another couple quarters last year, at the end of the year, back to profitability. Is any sense of when sort of we can see consistent positive earnings from Trivago?
Yeah, I mean, I guess we were fortunate in a way that we realized that the pandemic would not be a temporary problem, but really a problem that would stay with us for multiple years. So we cut our costs very early, already April 2020 in the pandemic, and as a result managed to come out of it with a positive cash flow. So the lower cost base has helped us a lot to really manage and navigate through the very, very tough times in the pandemic. And now we and also most of the other online players are obviously investing into winning back the customers, into giving travelers confidence to travel. So there are investment quarters ahead of us, and you can really see that with many companies. And I guess it will take a few quarters and perhaps even a few years to get to a market that is truly stable. But we will invest into marketing this summer for sure.
Axel, last minute that we have with you, getting back to what we learned from executives from around the world at Milken just a couple of days ago. It seemed to be there was cautious optimism here in the U.S., but there was some serious concern about Europe, specifically about the health of the European consumer. What's your take?
Yeah, it's a difficult question. I think the biggest concern that I would have is it's global, which is the skyrocketing inflation, and I guess that's where you were starting before we start the discussion. That is obviously a concern, and it puts pressure on people around the globe. But other than that, I do believe that there is not that much of a difference in terms of economic outlook.
All right, we're going to have to leave it there. Axel, we always love it when you join us on Bloomberg Business Week. That's Axel Hefer, the CEO of the travel platform Trivago, joining us live from Germany. Well, let's get a check of all of the after-hours action and the latest business news. Here's Charlie Pellet.
Hi, thank you very much. After Hours just heard from eBay, and it gave a lackluster sales and profit outlook for the current quarter, accelerating its decline from the peaks reached when shoppers were stuck at home during the pandemic. After Hours, eBay shares are tumbling by just about 6%. It was an up day, and that is putting it mildly today. The Dow, the S&P, Nasdaq, all surging. Treasury yields fell after Fed Chair Jay Powell eased concern the central bank will embark on a more aggressive pace of monetary tightening after delivering its steepest rate hike in 2 decades. Here's Fed Chair Jay Powell today at the news conference.
We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
But a key takeaway, no 75 basis point increase. Reaction from Brad McMillan, Chief Investment Officer at Commonwealth Financial Network, who is our guest right here on Bloomberg Business Week.
The real message here from Chair Powell is we've got this. The Fed is under control, and we see the economy growing. We see the inflation. We're doing what we need to do, and we're going to continue with the path, and there's a plan, and the market loves a plan.
And indeed, the market loved a 124-point jump today for the S&P 500 index, up by 3%. The Dow up 932, up 2.8%. Nasdaq surged 401, up by 3.2%. 10-year yield 2.93%. 10-year up 9/32. Spot gold up 0.8%, up $15 the ounce to $18.83. West Texas Intermediate crude up 5.1%, 107.67 a barrel today on WTI. Lyft plunged after the ride-hailing company's second quarter outlook disappointed Wall Street, highlighting investors' willingness to dump growth stocks at the first hint of trouble. Today we saw Lyft plunging 29.9%. Uber also down today, Uber falling by 4.6%. Intercontinental Exchange is buying Black Knight Inc. in a deal valuing the mortgage software provider at about $13.1 billion, as the owner of the New York Stock Exchange made a huge bet on the future of the U.S. housing market. Today, we saw Black Knight shares up 14.5%. Intercontinental Exchange was down by 4%. Recapping 10-year yield 2.93%. S&P surged 124 points on this Fed Wednesday, up by 3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, you all know our next guest. He's an executive producer and the star of Bar Rescue, where he helps transform struggling small businesses. He's also a New York Times bestselling author. He's also got a new book out. It's called The Power of Conflict. Speak your mind and get the results you want. John Taffer, it is good to have you with us in the Bloomberg Interactive Brokers studio. How are you?
I'm doing great, guys. Good to see you.
Yeah, it's good to see you. I want to start with the economy, because given what you do, you have such a good look at small businesses. Yeah. You talk to so many small business owners. You have a good understanding of their sentiment, how they're feeling, how they're doing. You've talked to us a lot about that. But I want to start with Jay Powell and the Fed chair's comments earlier today. The economy is resilient. The economy is strong. Inflation is high, yes, but the labor market is so tight that the economy can withstand higher interest rates. How do you see things?
Well, I think that those are fine public relations statements, but I think the lives that people are living in the worlds that I travel are telling them otherwise. They're seeing day-to-day differences in their economics, day-to-day differences in their perceived security, day-to-day differences in so many areas of their lives that cause fear and concern, that there is an unsettling, if you will, disruption to moving in positive ways. And I say that in a very, very broad sense. I see that investors are holding back, right? They're concerned the corporate tax rates might go up. There's a lot of things going on around us that is causing an unpredictability. I see employees being concerned with their workplace. I see them reassessing their careers and their jobs. We see people quitting their jobs at higher rates than ever before, but yet a huge percentage of American workers don't have more than $1,000 in the bank. But yet they're quitting jobs. So something has happened that I think has struck the nerve of our country, which is changing the behavior of our workforce. And I think it's a very powerful dynamic that we have to overcome the next 2 years. And it's not spoken about enough.
John, I'm curious your read on sort of the bar and restaurant industry writ large. One of the saddest things, obviously the sickness and the loss of life was the saddest thing of the pandemic, but to see all these really hardworking bar and restaurant owners, the small mom and pop shops, really struggle with the lockdowns and the closure. Where is the industry right now? Is it almost back to where it should be, or is there still a lot of room to go?
Well, what's interesting is when you say that, I think of the restaurants that existed for 70, 80 years that went down in a pandemic.
Right.
4 generations of ownership, and they didn't make it through the pandemic. Generally speaking, the industry is up 20 to 25% in revenues above pre-pandemic levels.
Wow.
So, look at the quarter Las Vegas had. I live in Las Vegas. The casinos had a great quarter. So we talked about that pent-up demand and how long would it take people to came back. They came back. So from a top line standpoint, the industry is looking great. Here's the issue. We're losing brand equity because we can't get employees to serve people properly. Obviously, the inflationary impact is huge upon our prime costs, food costs and beverage costs. So we see the revenue opportunity is greater than we've experienced in years, but seizing those revenues is really a challenge. So companies that are so service-oriented now are not achieving their own standards of service that are so important to their brand equity. That's scary.
Yeah. Well, John, what would you say to somebody who said, wait a second, people in the service industry, low-wage workers, have been left behind for so many years. It's about time that they saw better conditions or wage increases. You know better than anyone, this is really, really tough work.
Yeah.
And they deserve higher pay, no?
Oh, of course they do. And, I'm all for increasing their wage, but I'm supportive of doing it in steps. I don't think that, for example, states that have employee tip credit, you bring them up to $15 an hour, that's a 600% increase in pay overnight. No business can sustain that. So let's bring it up in 3 or 4 steps. Let's get it there over 2 years. Let's allow the industry to adjust as we go. But I completely agree. If we're going to retain employees and turn my industry back into a career-based industry, we need to get it to that level. But I also want to highlight that if you're a waiter in a good steakhouse, you're making yourself well over $1,000 a week in many steakhouses. So there are those in the industry who make an awful lot of money as well. So some are doing well, some are not doing as well. I think as an industry, we need to step up.
That voice you hear is John Taffer. He's host and executive producer of Bar Rescue. He's with us for the first time in a couple of years, John, live in the Bloomberg Interactive Brokers studio. He's got a new book out. It's called The Power of Conflict, Speak Your Mind and Get the Results You Want. He's with us, Mike Regan, Bloomberg News, senior editor, and Tim Stenevec live in the Bloomberg Interactive Brokers studios. We're going to be back with him in just a few minutes. Looking forward to talking to John about the new book, about the show, and of course, continuing to talk trends that he's seeing, especially in different areas of the country where we're starting to see more and more people move as we start to see continued great migration. This is Bloomberg Radio, and this is Bloomberg Business Week. Let's now head from New York City down to Washington, D.C., where Nancy Lyons is standing by. She's got to check the latest world and national news. Hey there, Nance.
Thanks, Tim. Russia's defense ministry is promising to provide safe passage for civilians who are still trapped in a steel plant in Mariupol. It says the offer applies to May 5th through the 7th. Interfax is reporting the civilians can choose whether to go to Russia or Ukrainian-controlled areas. Today, President Biden was asked if the U.S. is willing to consider additional sanctions on Russia.
We're always open to additional sanctions, and I've been in consultation. I'll be speaking with the members of the G7 this week about what we're going to do or not do.
The European Union has been looking at imposing a full ban on Russian oil and gas, but that would still need approval from countries like Hungary, who rely heavily on Russian gas. To better compete with China on quantum computing, the White House is boosting support for the next generation technology here at home. Bloomberg's Nathan Hager has more from Washington.
President Biden is issuing a couple of tech-focused directives. One would require the country's most vulnerable IT systems to adopt new standards against the threat of code cracking from quantum computers. Federal agencies will also have to develop comprehensive plans to safeguard America's intellectual property from acquisition by adversaries. They'll also have to educate industry and academia on the threats they face. The U.S. is locked in a race with China to develop the underpinnings of future technologies, from semiconductors and ultra-fast networks to quantum computers. In Washington, I'm Nathan Hager, Bloomberg Radio.
The owner of TurboTax will pay out $141 million to Americans who paid for services that should have been free. A nationwide agreement will see Intuit pay restitution to 4.5 million consumers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons, Tim Stenevec, and Mike Regan. Live in the Bloomberg Interactive Brokers studio, we got John Taffer with us. He's host and executive producer of Bar Rescue. He's also got a new book out. It's called The Power of Conflict, Speak Your Mind and Get the Results That You Want. John, when Nancy was doing news just now, you made a really interesting comment, saying that we live in interesting times these days.
Yeah.
What brings you to that? I mean, I don't think anyone would argue with that, but what's top of mind for you?
Yeah, I'm one to look, I took cultural anthropology in college, so I've always been one who studied behavior. human behavior. As a business person, I'm one who tries to change human behavior, right? I want to market you to buy things. And so I'm a real student of human behavior. And the past 2 years, I see, decisive changes in our behavior as a society. The way we interact with each other, the way we interact with businesses, the way we complete transactions, the traffic, the cycles. There are so many changes around us that it creates a certain unpredictability.
Are people being more respectful? There was this moment where I think there was a sense of unity early on in the pandemic where, here in New York City, we would go out on our, open our windows and bang pots and pans at 7 p.m. for healthcare workers each night. And there was this idea that we were all in it together. Do you see that in your industry?
I do. I certainly see it in the industry.
Because we're also seeing videos of people getting kicked off of airplanes, dragged, kicking and screaming.
Yeah, I think that togetherness has sort of eroded a little bit that we sort of experienced in the earlier middle part of the pandemic, and that's one of the reasons why I wrote the book. People today engage in conflict without dignity. And it's the loss of dignity that has really destroyed our political landscape and destroyed our professional landscape in very many ways. So when I wrote the book, I realized, I've done 230 episodes of Bar Rescue. The last 150 or so, I haven't been angry when you see me angry. I'm being deliberate. I'm being manipulative. I have a purpose. And I'm using conflict as a tool to achieve an objective. And I started to realize, wow, conflict is a dirty word that shouldn't be.
Well, we're going to talk much more about the new book by John Taffer, host and executive producer, also author, entrepreneur, and so much more. He's with us in the Bloomberg Interactive Brokers studio. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Lots of earnings after the bell. Just heard from MetLife, the biggest American life insurer. It's out with earnings that beat analyst estimates as losses related to its derivative holdings decreased and claims from COVID-19 related deaths also declined after hours. MetLife up now by about 0.7%. eBay, though, heading the other direction. It gave a lackluster sales and profit outlook for the current quarter, accelerating its decline from the peaks reached when shoppers were stuck at home during the pandemic. Right now, eBay is down by about 5.9%. A Fed Wednesday, and stocks rallied the most since May of 2020. Treasury yields fell after Fed Chair Jay Powell, right here on Bloomberg Radio, eased concern the central bank will embark on a more aggressive pace of tightening after delivering its steepest rate increase in 2 decades. 10-year yield 2.94%. S&P up 124 points today, in advance of 3%. The Dow up 932, a gain of 2.8%. Nasdaq up 401, higher by 3.2%. Spot gold up 0.8%, $18.82 the ounce. West Texas Intermediate crude up 5%, $107.55 a barrel. Recapping, 10-year yield 2.94%. S&P up 124, up by 3%. Stocks roar as Jay Powell quells fears of jumbo rate hikes. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, I want to get right back to our guest. We have been speaking with John Taffer, the host and executive producer of Bar Rescue. He's with us in the Bloomberg Interactive Broker studio. He's got a new book out, The Power of Conflict. Speak your mind and get the results you want.
Yeah, Tim, I'm trying to speed read this here, but I open up to page 113. I can tell I like this book already. Let me just read you a line here. There's never a show where I don't yell, John says.
I think people know that, right?
He's referring to his show, Bar Rescue, the big hit show. There's always that moment when I need to shock an owner into changing an unhealthy pattern. You know, John, and correct me if I'm wrong, but I get the impression that the bar and restaurant industry is one where there is a lot of sort of heated moments and yelling and conflicts.
Yeah.
Then everyone seems to go home and forget about it, have a drink, come back the next day, and they're friends again. I don't know if that's I
think that's a safe. You know what it is? We get packed.
Yeah.
Right? There's this high energy. We're in the weeds. We're fighting. Then finally it mellows out at the end of the night, and everybody comes back to war again the next night. Because, you know, what's incredible about the bar industry, for example, the average bar will do 70% of its revenue 16 hours a week.
Wow. Just that
Thursday,
6
Friday,
to 10.
Saturday. So it's a crunch. You know, it's high pressure.
But I wonder, and I know you've looked at sort of not just the bar and restaurant industry, you sort of looked at conflicts in other business. I mean, does conflict translate into all businesses, or is it sort of, taboo to sort of engage conflict and sort of, is the risk greater than the reward in other industries?
You know, I think that conflict is a critical aspect to every industry. But what is conflict? It's perceived as a dirty word. You see, if you want to win in conflict, in business, in professional relationships, in any aspect of your life with another human being, we succeed when we pull them in, not when we push them away.
Right.
Success always comes, whether it's pulling an employee in, pulling your boss in, pulling your spouse in. So conflict can't push people away. It needs to pull them in. So that's what the book is about, is engaging in meaningful conflict, positive conflict. I love the Disney story that's in the book.
Tell us about that.
Roy had the checkbook. Walt had the ideas. Walt's ideas would have made him go broke if Roy didn't have the checkbook, and they would talk about it all the time. There's a famous story where Walt went out of town on a business trip for 2 days. He had spent all the money in the company. When he came home, Roy sold his car. But the greatest story of all was Snow White, the movie.
Yeah.
And there were flickers in Snow White, a defect in the film. So Walt goes to Roy and says, I got to fix the film. It's $150,000. Roy says, no, you're not fixing the film. Well, they never fixed the film, and if you watch Snow White to this day, those flickers are still in it. If budget doesn't manage creativity, there'll be no money for creativity. It's the conflict between those two elements of a business that create that success, if you will, that governance on either side, the big idea that creates the budget allocation, and the budget realities that limits the creative exercises. That's a conflict that drives every business.
John, unlike you, I think Tim's gone about 1 million TV and radio shows without yelling at anyone. I don't know. We got to get him. What can we do? I don't know what to do to get Tim to yell at me.
Yeah, that's the truth. Well, it's true though. It actually makes me think about my own management style or my own style of being managed. And I wonder about the idea of the squeaky mouse.